pundits have pointed to a number of external challenges to the local economy, ranging from the threat of warfare over Ukraine between Russia and Western allies to soaring oil prices. For more, I have Professor Yang Jun-sung from the Catholic University of Korea. Professor Yang, it's a pleasure to have you here.
Happy to be here.
I also have Professor Oh Jun-suk from Soomyung Women's University. Professor Oh, welcome back.
Thank you for having me.
Right, Professor Yang, what would be the global economic toll of a Russian military invasion of Ukraine?
Okay, well, if there's a military response by all sides, then it becomes basically, at least in the short term, unpredictable. So I'm going to stay away from predicting that. But if there is a non-military response by the Western allies, then there will probably be an embargo. And economic embargo we can talk a little bit about. The most likely effect will be on oil prices. Some analysts have said that it might go as high as $120 per barrel if there is an invasion by Russia and if there's an embargo. This is not necessarily because Ukraine is a major producer of oil. In fact, it's only about 61st largest producer of oil, so it's in a sense of an oil producer, they're minuscule, but where they are important is that they channel a lot of gas, natural gas and oil from Russia to Europe. So that channel may be cut off. And then natural gas is especially important for Germany as a fuel oil, so it may add an additional demand for oil as well. So that accounts for a major reason why the oil prices will rise. But also we cannot rule out the possibility that Russia will limit exports as well. Russia is a top 3 oil producer and one of the largest exporters. As I said, the analysts are saying $120 per barrel. I wouldn't be surprised if it went above that for a very short period, a few days, especially after a shock of invasion and if the Western allies decide to have a military response. But oil prices will probably be the biggest hit on the global economy, and then there will be probably an additional effect on grain prices as well, because Ukraine is a major grain exporter to European nations, and once that grain supply has a shock, they will have to get grain from elsewhere. Now, problem with oil and grain is that they're what we call inelastic products. So even a tiny change in supply can lead to a very high response in prices. So that is the risk that we're facing right now.
Right. And Professor O, what are your thoughts on the potential impact of such hostile developments in Eastern Europe, perhaps on the Korean economy?
Yeah, Ukraine is located in the junction area between the European countries and Russia. And then the geopolitical tension being considered, I must say that it will be a hard blow to the Korean economy in 2 ways. First, international trade and international investment of Korea got a red alarm. As for export market, Ukraine is a big emerging market with a population of 43 million. So we paid more attention, and then Korean companies already invested a huge amount of money. And then might be Korean companies might be Samsung Electronics, LG Electronics, and then Hyundai, POSCO International, and so on. So logistic-wise, Ukraine is a bridge connecting the Russian market with the European market. When gathered together, it could generate scale economy effects. Due to this kind of military tension, that the Korean export will be affected negatively, especially in the sector of cosmetics and the electronics and cell phone and automobiles. And secondly, as Professor Yang commented about that, global instability of supply. Russia is the #1 natural gas exporter, whereas Ukraine is named the breadbasket of Europe. It's a major grain supplier in European countries. So military conflicts means the supply instability in an economy, which means the sharp increase of overall price in the market. It might trigger a vicious cycle in an economy. So we have to pay more attention on the trend of this kind of movement.
Right. Professor Yang, staying with the potential economic consequences for Korea, what look to be the repercussions of a prolonged confrontation with regard to the Ukraine situation?
Okay, well, I actually think that more prolonged and settled, as long as it does not go to actual armed conflict, we may have a bit of a stabilization after a few weeks. But before then, we will have problems with unstable global goods and financial markets. I'm currently a bit more worried about the financial markets. Usually when we have problems like this where it involves possible armed conflict and possible large changes in the price of oil, what we see a lot of times is flight to safety. What we see is money taken out of the emerging market and then going into the United States, treasury bonds, even within a single country, you move from, say, risky investments like stock market into bond markets. So we may see a very rapid changes in both global and domestic financial markets, coupled with rising interest rates in the United States and Korea. So that's probably in the short run the biggest effect that we're going to see. In the longer run, as people get perhaps settled down, there is a possibility that other Middle East countries will increase their oil supply. There is possibility that because, well, Korea does have a lot of foreign investment in Ukraine, but in terms of just actual amount of exports and imports, they're less than 1% of Korea's total exports and imports. So if we get over the initial shock, it may not affect us that much in the trade account. If there is an armed conflict, Korea facilities in Ukraine may get damaged, but if they don't, I don't think it's in the interest of Russia or Ukraine to deliberately destroy those facilities, so it may go back online. But at least for the first few weeks, I think we will have a very large shock if Russia does decide to invade Ukraine.
Right. Professor, the standoff between Russia and Ukraine has been affecting energy and commodity markets, as Professor Yang mentioned earlier. What look to be the ramifications of this reality on the local economy here?
EU relationship with Russia is one of interdependence. Russian gas make up 40% of EU supplies, and at the same time, Russia still relies heavily on energy sales, more than 30% of their economy, and then more than 60% of its export. So I'd like to comment about the Korean domestic economy. As Professor Yang commented about the commonality of the two regions, in case of Russia, they have energy producers, and then in case of Ukraine, is a grain supplier. So their commonality of inelastic, which means the small changes is brought out of drastic volatility, wide volatility. So in that case, that energy price increase will cause overall production cost increase in Korea, in an economy, which will reduce the level of production and then decrease the investment and then unemployment and so on and so on. So in this process, economic recovery from the pandemic will take longer than expected. But there is a catch. Go to the international economics. When Russia planned to this kind of military invasion, strategically they thought of they want to try to make an alliance with China. So think about it. No wonder there seems no compromise of trade conflicts between China and the United States. Number one and number two trade partner of Korea. So Korea might be stuck in the middle, and there will be a negative effect on the export forecast in 2022. Korea have to have a hard time finding a balanced diplomatic relationship without hurting the trade opportunities.
Right. Beyond Korea then, Professor Yang, what are the prospects of a hike in its key interest rate by the U.S. Federal Reserve that you mentioned, you touched upon earlier?
Okay, well, the United States, their January consumer price index inflation was 7.5%. That's the highest it's been since, I believe, 2008. That's on a 12-month basis. If you look at the subcategories, again, using the 12-month basis, the gasoline and used cars, their prices rose by more than 40%, and they account for a lot of the 7.5% increase. But because 7.5% increase is so big, there has been more and more comments, perhaps, that the United States will raise the interest rate by 5 to 7 times over this year. Previously, they were thinking about 3 or 4. And then in March, with the first rate increase, they may raise it by 0.5 percentage points rather than 0.25 as they usually do. The Fed has been trying to talk back that comment somewhat. The St. Louis Fed President Bullard had said that they may raise the rates 4 times by July, and realistically, that means they will have to raise the rates once by 0.5 percentage points. But he's been taking that back that comment and saying that nothing's been decided. There's a very good chance that there will be 0.25 percentage points. I personally think the first rate increase will be 0.25 percentage points because the Fed hasn't raised its rates for a long time, and I don't think they want to give too much of a shock to the system. But I think we realistically have to take into the possibility that United States will raise the rates more than 5 times this year, though I still think the most likely response is that they will raise it by 4 or 5 times and not necessarily 7 times like some of the investment banks are arguing.
Right, and staying in the U.S., Professor, what are your thoughts on the possible course of action that the U.S. Federal Reserve may choose to adopt?
Now, Federal Reserve must change and adjust it for their schedule originally planned. Let's think about a simple case. There is a pile of firewood in a stove, and then when the fire becomes bigger, and then it's too hot. So to control the heat, think about it. You may pour water into the stove. The stove is the economy, and the pile of wood is a money supply, and the heat is inflation. What about pouring water into the stove? That is interest rate hike. So this is a sudden change and that in line with moderate this kind of the sudden effect, they have to change the schedule. And then why that is because setting fire is more difficult to keeping fire. So it is true, once COVID caused a bottleneck to the supply chain are resolved, that inflation will subside. So the tension due to the Russian troops buildup might be might be affected on the change of the schedule when some people say that Beijing Winter Olympic ends, that there might be the time of moment of movement. So there is room for slack. And then time of waiting for the next interest rate hikes.
Professor Yang, here on the domestic front, what are the implications of such external variables on Korea's financial market?
Okay, as I said before, the worries I have the most is if the Ukraine situation blows up with armed response, then we may get a very large shock in the global financial market and flight to safety. Now, usually Korea is classified as an emerging economy, so that means we may see a very large capital outflow going from Korea to the United States or other advanced countries. But there is, I think, a little bit of hope because when we had the taper tantrum in 2013, the capital outflow wasn't as large as a lot of people expected, and the interpretation at that time was that people were taking Korea to be an advanced country rather than an emerging country. Perhaps Korea is acting more as a safety region rather than a risky region. But we only saw that in 2013. So that's speculation right now. Right now, the much more likely scenario is that if there is a flight to safety, we will see a very large movement out of Korea, a capital movement out of Korea into advanced countries. We will see a very large depreciation of the Korean won because of that. And even domestically, we will see a large drop in the stock market and moving into the bond market. It will probably be temporary because that's what typically happens in an armed, unpredictable situation. But still, for a few weeks, we may be in a very volatile, unpredictable situation.
Professor Oh, moving forward, a number of countries in Europe as well as the US are seeking to transition into a new normal as the COVID-19 situation there appears to have reached its peak. Having said that, how does this reality look to affect global supply chains, do you think?
Using the economic terminology, it's a monetary veil. So in the short term, it could be possible, but as Professor Yang commented, it's a temporary. It cannot be sustainable. That is because this is an economic urgency, and then the market does not function well. So in time of urgency, the government take a role of circulating the economic cycle at the sacrifice of budget deficit. So it cannot be sustainable. So as time goes, the market shows and then uncover the veil, which means it might someone has to pay the price for the consumption eventually, which means the next generation have to pay the obligation. So in this sense, that in the long term, this kind of normalcy appearance might not be sustainable.
Right. And moving from the West back to the East, Professor Yang, some economists say that supply chain disruptions are being aggravated by China's zero-COVID policy amid Beijing's hosting of the Winter Games. Do you see an ease in disruptions once the Games end this weekend?
No. And the reason is that while the Olympics in China may play some minor part in supply chain disruption, it doesn't play a major part. The major part is due to, first of all, the supply problem is coronavirus. It's especially with the China's zero coronavirus policy. And it's not only China, it's other countries as well. Coronavirus is limiting supply in a lot of these factories, and then it's limiting movement in a lot of marine transportation. Again, that's not necessarily China, it's all the other countries as well. We have to remember some of the less developed countries, they still do not have vaccination, proper vaccination. They're still vaccinated less than 50% of their population, and the people who work on ships are among the last people to get vaccinated. And then there's also a shortage of containers that's still not worked itself out. And then the second problem, which is on the demand side, is that a lot of this disruption, supply chain disruption, is because there's a lot of demand for goods from the United States. Now, that may run itself out toward the latter part of the year as the interest rate goes up and U.S. savings that they built up during the pandemic goes down. But still, right now, the goods demand for goods from the United States does still seem to be strong, so it's taxing the limited infrastructure that we have right now. And just by the fact that China is finishing their Olympics and some areas in Beijing is being more liberalized to do what they want, I don't think that just bring that certain region of China will do much to alleviate the global supply chain problem.
Right. And back on the domestic front, Professor Oh, inflation here in Korea has increased by over 3% every month since last October. Do you expect this trend to continue?
Yes, I'm afraid I think so. Because there is a growing doubt over whether the government will keep its target rate. Target rate of consumer price increase is 2.2%. But last year, consumer price is already over 2.5%. And the Bank of Korea changed its outlook for this year. Consumer price rise from 2.2 to 5, and then there happens a Russian military tension. It will add the cost of increase in the world. Korea might be affected as well, and then I suppose it will be up to 3% of price increase.
Right. Professor Yang, the central bank, for its part, has shared intentions to curb inflation by raising its key interest rate, as well as dealing with rising household debt, of course. Having said that, what other options do you propose to tackle the latter, that would be the rising household debt here?
Okay, I think personally the debt service ratio regulation that they introduced A lot of people see this as a barrier because it keeps them from buying houses and so on, but this debt service ratio regulation, DSR regulation, I think it's something that should have been incorporated into Korean lending from the beginning. Now, if you go to, say, United States or Europe, even without government regulation, they calculate your DSR anyway because that gives you a good idea on whether this person will be able to pay the debt back. And if this person has gotten too much into a debt problem that they cannot afford to pay, then the debt service ratio stops the bank from lending money to this person. So DSR regulation, it's been introduced by the government, but I think it's something that should have been introduced by the banks on their own, lenders on their own to begin with. Also, something similar should be applied, I think, to corporate loans as well. We've been mostly worried about household loans because that's the highest in percentage of GDP that in the OECD countries, but Korea also has a very large corporate debt as well. In fact, in terms of absolute amount, it's higher than the household debt. We feel a bit more safe about corporate debt because, well, debt is just part of regular management, but still, Korea is among the highest. So we should try to get a handle on corporate debt as well. And then there's the government debt, but that's a whole nother topic.
Right, it is. And hopefully we'll have time to talk about it some next time then. All right, Professor Yang, as always, thank you very much for your thoughts. Professor Oh, thank you for your insights today.
Thank you.